to the newsroom. Let's connect with our expert for today. The big voice that is joining us today is Mr. Seshadri Sen, who is the head of research at Alchemy Capital Management. Hi, Mr. Sen. A very good afternoon. This is Shrishti. Thank you so much for your time. First of all, wanted to have your take on the markets then, because the market seems to have digested the budget announcement, seems to be happy too, even after the announcement related to the LTCG as well as STCG. What's your take on the budget, and given the run-up that we have seen on the benchmark indices, do you believe that the valuations are also supportive too, given the kind of fundamentals that are playing in the Indian economy?
Hi, Srishti. Thanks for hosting me on the show. Small correction, I am the head of research at NK Global. Um, you asked two or three questions there. First of all, in terms of the budget, we thought it was quite a reasonably positive budget. The fears that the government would pivot on its economic agenda did not materialize. The fiscal consolidation, which has been, I think, a very important factor in driving this bull run, was sustained. The focus on capex did remain, though the government did use the RBI dividend windfall to boost consumption and employment, which I think balances out growth a little better going forward. And while there was a setback in terms of the slight increase in long-term capital gains, I don't think that was a game changer, and I suspect the market feared a little worse on that front. So all in all, I think the budget was an incremental positive for the market. You asked again on valuations. That's where we are a little worried. If you look at the Nifty long-term valuation chart, these are levels from which the Nifty typically corrects. It doesn't seem to be doing so this time. And that, I think, is largely because of the positivity around the economy and the sustainability of domestic flows, which doesn't seem to be stopping at this stage. Remember, there was a bit of an FPI sell-off after the budget, but the market digested that fairly comfortably. But we do remain a little bit worried on valuations, especially in some of the industrial sectors where the ROEs and cash flows are not that strong to support these elevated valuations despite the higher growth.
All right, Sheshadri, that's the take that you have given on the valuation front as well. But just wanted to know that which are the big themes that you are spotting in the markets right now, because just after the budget and even before the budget, given the earnings support, we have seen that consumption theme is playing well. And we're also seeing that a select companies, the numbers are quite supportive, and stocks, companies like Colgate too are highlighting that the rural push is indeed there. So what's your take on the consumption basket, as well as apart from that, is there any big theme that you believe that can play well in the current market setup?
That's a very good question. Our contrarian views quite some time ago we pivoted away to FMCG and IT as our preferred sectors because they were long-term underperformers. We do think that this could be the year for consumption. First of all, if you look at earnings growth for FMCG companies, they're probably the best in terms of what they've delivered in the last 3 or 4 years. Mainly based on the fact that we had volume growth turnaround quite some time ago, but revenue growth is starting to come back. Margins and ROEs are therefore starting to look a little better in FY25 versus FY24. It's not a cheap sector, but remember, it generates very large cash flows and has very high returns. So you're not going to get that sector cheap anytime, too cheap at any given point. So we remain constructive on consumption as a theme, and we probably this is a year when you see mass consumption do better than premium. Post COVID, we've seen a 3-4 year run where premium consumption has outperformed mass consumption. Maybe that will start to reverse in this year. The second thing that we like is IT, though that has run up a lot and swallowed some of our positiveness. But we do maintain that IT is at a certain valuation. IT looks attractive, and if not immediately, then with a 2 to 3 quarter lag, the fundamentals in the IT sector will start to turn around. Um, so those are our preferred. We also like consumer durables. We think the auto cycle is not dead, and auto ancillaries are a better way to play the manufacturing cycle at this point in time.
All right, Mr. Sen, one more sector that is once again seeing some bit of a renewed interest from the investor side is the oil and gas space. Wanted to have your take on that because it's the crude that is falling for the past so many days now, and India seems to be beneficiary of that particular movement in the global markets. But back home, there's a lot of interest and a lot of talks going on with respect to some changes in the tax structure. But at this point in time, given the valuations and given so many regulations around, do you believe that oil and gas, even the power space, is something that investors should look at?
Yeah, we do think that energy should be something that we could look at given low falling oil prices. Selectively, some of the energy companies do benefit from falling crude prices, and some of that has already played out. But overall, we do look at energy as the other sector where you could look at playing the manufacturing cycle versus industrials where the valuations are a little stretched. On industrials, we prefer small and mid caps, the stock specific ideas rather than playing the sector from a top down perspective. But you could replace that with energy. Yes, we remain constructive on that sector as well.
All right, and lastly, Mr. Sen, wanted to have your take on the mid and the small end of the markets, because it's not just the benchmark indices that are seeing stellar run up, but every day, like day by day, we are seeing the broader market is supportive too. So, any place or any area where you see that there could be some froth, and investors should actually have a view of caution over there. What's your sense? Any sector that you wish to highlight?
Um, in general, yes, there is a lot of high valuations persisting, and I'm deliberately avoiding the word froth because that sounds a little sensational, and we've been a lot, market participants have been saying this for the last 2 or 3 years, but most small and mid cap stocks continue to outperform. Structurally, we are constructive on small and mid cap because this is a cycle where some of the sectors which are doing well, industrials, auto ancillaries, etc., are dominated by small and mid cap stocks. So they will, by definition, outperform. So we are not worried that small and mid cap is outperforming large cap. There's a reason for that. We are seeing a change in sector participation as far as the broader market is concerned, and that therefore will lift up the small and mid cap. We would, however, be careful. We would be more picky about which small and mid cap stocks to pick. We have seen in the post-COVID market that there are periods of overvaluation, but they correct fairly soon, and it's been very difficult to make money even in the best stocks if you buy them at the wrong valuation. So we would advise investors to be careful as far as small and mid cap, but that doesn't mean that the SMID story is dead. Structurally, I think it will be SMIDs outperforming large caps if you take a 2 to 3 year view.
Mr. Sen, also one more sector, that is the IT space, because it's not just the earning push that we are seeing in the large and even the mid and the small cap IT companies are just continuing the cheer. But apart from that, the investors are also molding their assumptions now. The commentary is on the positive side, but given the kind of an underperformance that we have seen, especially in the large cap IT space, what will be your pegging theory? What would you prefer amongst the large and in the small cap of the IT space right now, or would you prefer IT space or not?
Yes, as I said earlier, we are overweight on IT. Some of that, the sector's already run, so some of our bullishness has been absorbed by the prices. But we still continue to, would stay invested in the IT space, and we continue to maintain our overweight stance. Our preference at the moment is for large cap because that's where the valuation comfort is. There are plenty of good ideas in the small and mid cap IT space, but those are selective. But as a top-down perspective, we prefer the large cap in the IT space. We think that's where the turn will come. That's where the incremental delta in earnings will come, and valuations are still not unreasonable in that space.
All right, Mr. Sen, with this, we'll let you go on that and would like to thank you for taking the time out and joining us on ET Now today and sharing your perspective on the markets as well as
Thank you
talking
so much.
on different sectors. Thank you so much. But